All righty. Good morning, everybody. Hopefully, I'm coming in strong, but not too strong. As usual, I like to give just a moment to let people join and continue to filter in. So while we wait for just 30 seconds or so, give me a thumbs up, yes, whatever it is that you can hear me loud and clear. All righty. In that case, let's get going. Welcome to the Hurley Investments Trade Findings and Adjustments of October 5th, 2023. I'm not sure how much you can hear other than my voice, but you should hear a jet plane flying by, maybe a little bit of breeze. You might hear some cars driving on the road. Oh, we got a big semi. Hold on, everybody. Hopefully it'll quiet up here. I just thought it would be nice to sit out on my back deck and enjoy the last few sunny days of our, I guess we're not in our season of summer anymore, but nevertheless, the last few sunny days of the year. As we get into our fall months and everything starts to look kind of crappy. So hopefully you can hear me good enough and it's not too irritating. Let me know if it is. What have we talked about recently? So this was actually back on September 14th. So back here, I had it already, September 14th, and it was just before the week our market decided to tank from our FOMC meeting. And I definitely thought that the Fed was going to raise rates. I was mistaken. They did not raise rates, but our market didn't love the comment from our Fed that they were looking to keep rates higher for longer, and we could probably still count on one or two rate hikes more this year. My guess is it's going to be probably one more, since they're still thinking higher for longer rates instead of more rates in a short term to then cut rates sooner than later. That I was looking at. And so what has this done? Well, recently, that has created a problem for our longer term 10-year treasury bonds. So, which would make sense since if the Fed is going to keep rates higher for longer, therefore Treasuries 10-year, I'll just put this on a new line, 10-year Treasuries yields go up. So what does that mean, all of you economists and investors out there? If our 10-year Treasury yields go up, those longer terms, why is that affecting our stock market? Why have we absolutely tanked so far in the last 3 weeks? Dave said it might influence people to go into treasuries as they can get a better yield for less risk. Well, yeah, and sort of. I would think the stock market could make more than 5% in the next 10 years, wouldn't you? So that's kind of how it is, but not seeing any more comments. So if rates are higher than for longer, that puts pressure on, the housing market, and people will not be looking to buy houses as much because, with those rates higher for longer, that's a lot more interest you're going to be paying rather than hoping that they're going to cut here soon and get back in to buying more houses. It puts a greater burden on companies that are borrowing. And still our short-term treasuries, as high as they are, that is, in my opinion, what is mostly influencing our market, because people can go just put in a money market or a CD account and get close to 5% or more. That might be more realistic in the short term than maybe risking more in the market. I think that has a lot to do with where we're at. So, what are we looking to do? We're definitely still looking at covered call positions. We can go over that in a minute. But I kind of want to see if we can just take a step and look at things a little bit longer term. Let's see, we don't need to talk about any of this. We had booked some puts on 220 Boeings, 185s, 140s on Baidu, 88s on Disney. Let's look at Apple. 185s on Apple. Probably this day. Those look good. We booked those, but obviously we're having to put some back on. So we got 175s there, but it's important to keep those past profit in mind. Boeing 220s, and I think we still have, if we don't have 220s on, we must have rolled them sooner than later. Let me just, I'm not logged in, so I can't see, and it keeps kicking me out. Bear with me. I know you can't really see what I'm doing. I'm trying to log in here and see if I can. Find some things. Bear with me, guys. Just want to see where we have Boeing to remind myself. And currently we have a 205 put, so we definitely rolled that down. That looks great. Sorry, I can't show you more. I just don't want to show account numbers. That's what we've got. All right, so man, is Boeing ridiculously oversold. And then of course Baidu, Disney booked some profits and got protection back on over a week ago. And again, this is for back in September, mid-September. We can erase this, but I thought it was important to note. We got protection on since rate decision. And we basically just kept a lot of it on. Obviously, those profits I explained to you, but we're in a time period of just having protection on. Which brings me to my next point. What is our put protection for? We just have that protection to book profits and trade, or just we just looking for short-term profits like the ones we booked a month ago? Do we just book short-term profits to game the stock market? Or are we focused on the concept of ensuring stock ownership? Jim said, protect us in a downward market trend. Of course. Yes. I guess the point I'm trying to make, and I'm trying to make sure that you guys understand. Yes, back here we booked some profits on Apple and Boeing puts. But did we book those profits just for the short-term, short-sighted sake of getting a couple bucks? So obviously the answer is no. So why didn't we just leave them on? Why not just leave them on? 220s, this is a better example. 220 puts on Boeing, we be looking awful good right now. Why take them off? Well, it might be smart to have just left this one in particular on. But guess what, guys? What we know now is not exactly what we knew weeks ago. Following this trend, 205s are way up here. So you can kind of see the idea. Hey, it's coming down to this 200-day moving average, big support level. We've got 220 puts. On the off chance, since it's holding a couple days here on the 200-day, let's book some profit on those. And if we need to roll them down, buy them again, we can do that. But we're at a support level. It would be awful foolish to give away some of that protection profit if Boeing decided to bounce here. Of course, then they keep having a couple more troubles with their production. 205 was the closest strike price we could get when it fell down here to 206, 207. So we got 205s back on, and we continue to protect our stock ownership and make up as much as we can of this longer term trend. So yes, sometimes there's some give and take as to when we're taking those puts off and on, but we're not just trying to make up these small bits for a short-term gain. We're weighing the possibility and probabilities of our current circumstances and what that might influence for our stock going forward. Lee said we need protection, but if there's no gain, then we aren't getting anywhere. Just keep the money in the bank. Yes, I like that, Lee. We have to risk something being in the stock market, and we're doing our best, making up every bit we can on the way down, understanding that any of these stocks at some point could start going back up for our Christmas rally. Jim asked, should we be placing calls to protect upside as well at this point? You're referring to long calls, Jim? Don't know. I'm trying to understand what you're asking. No, I mean, we're not looking at adding new calls. We're really more looking at when we take in book protection so that we can add shares. For a short-term outlook, it might be something to add call options for a Christmas rally, but that's kind of a risk. Right now, it's just not a good environment. But I do think at some point we're going to have a little bit of a bump. All right, guys. So my overarching point, and I hope to get you to learn and also remember, those of you who have been around and kind of get what I'm saying. Yes, we booked a shorter term profit, but if you don't take a step back and look at the longer trend and the longer view, all you've got is a crappy profit, and you're not continuing to take care of your stock, because obviously your stock keeps going down. So if I don't let a short-term gain on puts make you think that we don't need to continue to protect our stock. And for some stocks, that's kind of a tricky spot, because now Apple, we're at 175 puts, so we've only got a little profit in those right now. But we just are in the situation where our market is doing this. And so it's not justifiable to be taking off puts at this moment. What's another one? Let's see. Meta. Another one that's kind of held up really well. We've got 300 strike puts on Meta, and it's just kind of been trading right around 300, 305, gotten as high as 312 a month ago. But basically, anytime it's gone to 310 in these last 4 weeks, it's just kind of popped down and stayed right at this 50-day. But again, here's our stock market. I'll look at here's our NASDAQ. Apple and Meta fit in that NASDAQ. Doing much better than the overall NASDAQ index. But you know, these things influence our little stocks, right? So we're protecting for the idea of insuring our stock right now, not for the idea of a short-term gain. So are we focused on the concept of insuring stock ownership, or were we just looking for short-term trading gain? And obviously, as we booked that short-term gain, maybe it looks like that, but we're focused on our current situation and feeling our way through the stock market and the current situation. And we got protection back on to keep protecting stock ownership. I hope this this concept is making sense. I don't know how well I'm getting across here, but let me just say, remember, there's a difference between trading options and puts. I'll just say trading put options and using puts like insurance on stock ownership. If we were more focused on just trading puts, we might have just booked that profit and maybe looking for the next trade. But if you're doing what we're doing, we booked that profit on the idea that that might have been where the stocks are getting to. And since it wasn't, we got to continue to ensure our stock ownership, to continue to follow the trend, to continue to protect our stocks, so that whatever point we've grown some cash with those put profits, we can buy more shares. Guys, I don't have a trade for you so much. You had that SPY put bear put I had that just erased. Hopefully you had done that. I would maybe look, if you've already got that portfolio protection there, look at something that's just not doing well. Maybe add some puts. And ironically, this is more for a trade, knowing that most of you probably don't have a target. Clorox, let's see, Clorox, there we go. Terrible losses for Clorox. That might be something. So just a couple of ideas for if you're looking to trade, look for something that's doing terrible right now and something that follows our current trend in the market. And then look to book a quick profit for next week as we get closer to this 200-day and seeing if our market decides to keep some support and head up for a Christmas rally. Maybe a little soon for a Christmas rally, and maybe we need some more positive news on the economic front that we really haven't necessarily gotten yet. And at that point, we can look at something bullish moving. But right now, that's not what we're looking at. Any thoughts or questions, guys? My battery is getting close to being burnt out, so don't have a lot of time, but any thoughts or questions before we wrap it up here? All right, guys, not seeing anything coming through. Thanks for joining me on my rear porch this morning. Lovely to be with you. Thanks, Jim. Thanks, Lee, for your comment. We'll see you guys next time. Take care.